$47 billion moved in silence. No emergency press conference. No flashing red banners on financial television. No official statement calling it a crisis. Yet for anyone who understands how global money really moves, that number should have stopped them cold. Because warnings in finance almost never arrive as collapses. They arrive as adjustments. In the last 12 months alone, the United States has added more than $1 trillion to its federal debt. Japan is quietly defending its currency by selling dollar assets. That is the warning no one is talking about. Before continuing, take a second to subscribe to the channel Finance Mind. This is where complex global money moves are broken down without hype, without noise, and without missing what actually matters. To understand why $47 billion matters, it helps to understand how modern financial stress actually begins. Markets do not collapse because of one decision, and governments rarely admit stress until options are already gone. Foreign participation has declined while domestic buyers. Against that backdrop, a $47 billion shift is not a headline. But markets are not moved by absolutes. They are moved by marginal changes. The question is never, is this enough to crash the market? The real question is why now? This particular $47 billion move occurred during a period when the U.S. is refinancing enormous amounts of debt at higher interest rates. Every percentage point increase in average interest rates adds hundreds of billions to future deficits. That is not speculation. That is math. Dollar-based financial infrastructure has been weaponized. Assets once considered neutral are now viewed through the lens of political alignment. That alone has changed how nations think about reserve management. China's reduction, the trend is clear, even if the pace varies. Japan has faced its own pressures, defending the yen by intervening in currency markets. It represents a calculated decision to reduce exposure at a moment when the system is already stretched. Emergency rate cuts. But the professionals who actually manage risk look elsewhere. They watch flows. They watch custody data. What makes this warning especially dangerous is how invisible it is to most people. There is no obvious pain yet. But financial history shows that stability right before a shift is often the most deceptive phase. In each case, the warning signs were present in the plumbing of the system, not the headlines. Even U.S. allies are quietly preparing contingency plans for a more fragmented financial world. None of this means the dollar is about to collapse. That narrative is lazy and inaccurate. The dollar remains dominant because alternatives are fragmented and flawed. But dominance is not binary. It can erode at the margins for years before the consequences become visible. That erosion shows up first in borrowing costs, then in currency volatility, then in fiscal constraints. The United States currently runs deficits during economic expansions. That alone is historically unusual. During downturns, deficits expand further. The difference now is scale. Trillions are no longer exceptional. They are expected. And as issuance grows, the system becomes more sensitive to changes in demand. A $47 billion reduction in demand today matters more than a $200 billion reduction would have mattered a decade ago, because supply is so much larger. This is where the warning becomes uncomfortable. If foreign demand weakens, domestic buyers must absorb more debt. That can happen through higher yields, regulatory pressure, or central bank balance sheets. None of those options are painless. Higher yields stress housing, equities, and government budgets. Regulatory absorption distorts banking systems. Central bank intervention risks inflation and currency credibility. The $47 billion signal suggests that at least one major player is no longer comfortable with the current balance of risks. That discomfort is not ideological. It is mathematical. Debt sustainability depends on growth exceeding borrowing costs. When borrowing costs rise faster than growth, the system relies on confidence to bridge the gap. Confidence is not guaranteed. It is earned and easily lost. This is why experienced analysts pay attention to relatively small but well-timed moves. They indicate changing assumptions. They indicate scenario planning. They indicate that someone, somewhere, is preparing for outcomes that are not yet public. It is also important to understand what this warning is not. It is not a sudden abandonment. It is not an act of hostility. It is not a prediction of imminent collapse. It is a hedge. Hedges are the language of professionals. When institutions hedge, they do not expect disaster tomorrow. They expect risk to rise. They expect volatility to increase. They expect the distribution of outcomes to widen. That is exactly what the global financial system is experiencing now. Geopolitical fragmentation, higher interest rates, aging demographics, rising fiscal pressure, technological disruption. All of these forces interact. None of them resolve quickly. The $47 billion move is a response to that reality. It also highlights a deeper issue: transparency. Much of the public data on capital flows is delayed, aggregated, or incomplete. By the time trends are obvious, the repositioning is already well advanced. Retail investors see the storm when institutions are already seeking shelter. This gap between perception and reality is where the real danger lies. Because when confidence finally breaks, it does not break evenly. It breaks where leverage is highest, where assumptions are weakest, and where liquidity disappears first. The warning, therefore, is not about one number. It is about the environment that made that number necessary. And that environment is becoming more fragile, not less. The next phase of this story involves how these pressures interact with markets, currencies, and political decision-making in ways that most people are not prepared for.
What makes moments like this especially dangerous is not what markets are doing on the surface, but what decision makers are forced to do underneath. When capital quietly shifts away from perceived safety, policymakers are left managing consequences rather than causes. And that distinction matters more than most people realize. Consider the position of the United States Treasury right now. Over the next 12 months, trillions of dollars in existing debt must be refinanced. This is not new borrowing to fund fresh programs. This is rollover risk. Debt issued at near zero interest rates is being replaced with debt priced at 4, 5, sometimes higher percentages. The difference is not marginal. It compounds. Every auction becomes a referendum on confidence. When a $40-7 billion reduction in demand appears during this phase, it tightens the margin for error. It means more issuance must be absorbed by fewer buyers. It means yields must rise enough to attract capital. And higher yields ripple through the entire economy. Mortgage rates follow treasury yields. Corporate borrowing costs follow treasuries. State and municipal finance follows treasuries. Even equity valuations, which depend heavily on discount rates, adjust when the risk-free rate moves higher. This is how a seemingly isolated shift becomes systemic. The warning embedded in that $40-7 billion move is amplified by who is making similar decisions at the same time. Central banks, sovereign wealth funds, pension systems, and large asset managers all operate under different mandates. But they share one common constraint: preservation of purchasing power. In an environment where inflation has proven more persistent than expected and where fiscal discipline is visibly eroding, the definition of safe assets begins to change. Safety is no longer just about default risk. It is about political risk, currency risk, and policy unpredictability. This is why gold purchases by central banks have surged. In 2022 and 2023, official sector gold buying reached levels not seen in decades. These purchases were not speculative. They were strategic. Gold does not yield income. It does not grow, but it is not someone else's liability. That distinction has become critical. The dollar-based system rests on trust. Trust that contracts will be honored. Trust that reserves will not be frozen. Trust that policy will remain broadly predictable. The weaponization of financial infrastructure has forced many countries to reconsider how much trust they can afford. Again, this does not mean abandonment. It means hedging. The $40-7 billion warning reflects that hedge mentality. It also coincides with growing stress inside the global banking system. Even after the high-profile bank failures of recent years, many balance sheets remain under pressure. Unrealized losses on bond portfolios have not disappeared. They have merely been deferred. Rising rates lowered the market value of long-duration assets, and accounting rules allowed many institutions to avoid recognizing those losses immediately. But markets recognize them. Liquidity stress does not announce itself loudly. It appears as reduced willingness to lend. It appears as higher collateral requirements. It appears as cautious positioning. When large pools of capital reduce exposure to sovereign debt, banks feel it. Dealers must hold more inventory. Balance sheets become constrained. Market depth thins. This is why auction outcomes matter so much. Weak demand forces higher yields. Higher yields stress existing portfolios. Stress feeds back into caution. The system becomes reflexive. At the same time, fiscal policy remains expansionary. The political environment in the United States makes meaningful deficit reduction unlikely. Entitlement spending continues to grow due to demographics. Defense spending remains elevated. Interest costs are now one of the fastest growing budget items. This creates a dynamic where borrowing is not a choice. It is a necessity. And necessity changes negotiating power. In past decades, strong foreign demand allowed the US to finance deficits cheaply. Today, that demand is less reliable. Domestic buyers can fill the gap, but at a price. That price is either higher yields or increased central bank involvement. Neither option is neutral. Higher yields risk slowing the economy sharply. Increased central bank involvement risks inflation expectations and currency credibility. This is the policy dilemma at the heart of the warning. The $47 billion shift did not create this dilemma. It revealed it. Markets often price outcomes, not causes. The cause here is structural imbalance. Too much debt, too little political will to address it, and rising costs of capital. The warning becomes clearer when viewed alongside currency markets. The dollar remains strong relative to many currencies. But that strength is increasingly a function of interest rate differentials rather than confidence alone. High rates attract capital, but they also increase domestic stress. If rates fall to relieve stress, capital may leave. If rates stay high, debt servicing becomes harder. This is not a crisis yet. It is a narrowing corridor. Meanwhile, alternatives to the dollar system are slowly developing. Not as replacements, but as supplements. Regional payment systems, bilateral currency agreements, local currency trade settlement, digital infrastructure that bypasses traditional clearing. Each individual development is small. Together, they change incentives. The $40-7 billion move reflects awareness of that shift. It is also worth noting that these decisions are rarely driven by a single country alone. Large reallocations often involve multiple actors moving independently but in the same direction. When several institutions reduce exposure at once, the cumulative effect becomes meaningful. This is how financial regimes change, gradually, then suddenly. Another layer of risk lies in political response. When borrowing costs rise, governments face pressure to intervene. Yield curve control, regulatory adjustments, and emergency liquidity facilities all become tools. These tools can stabilize markets in the short term, but they often carry long-term consequences. Japan offers a cautionary example. Years of yield curve control stabilized borrowing costs but weakened the currency. Defending the currency required selling foreign assets. Those sales fed back into global markets. Similar dynamics are possible elsewhere. The United States has more flexibility than most countries, but it is not immune to trade-offs. Every intervention solves one problem while creating another. The warning embedded in the $47 billion shift is that the margin for painless solutions is shrinking. Confidence, once lost, is difficult to restore. Investors remember policy surprises. They remember broken assumptions. They remember when temporary measures became permanent. This memory shapes future behavior. That is why the absence of panic is not reassuring. Panic is loud, repositioning is quiet. Repositioning is what happens when professionals believe risks are rising but outcomes are still uncertain. This is also why retail investors are often late to the story. Public narratives focus on extremes, crashes or booms. The middle phase, where risk is repriced without drama, receives little attention. But it is the middle phase that determines outcomes. The $47 billion move belongs to that phase. It suggests preparation rather than reaction. It suggests scenario planning rather than fear. And that is precisely what makes it dangerous to ignore. As borrowing costs rise and global alignment fragments, the financial system becomes more sensitive to shocks. Shocks do not need to be large. They need to be poorly timed. A geopolitical escalation, a policy mistake, a sudden slowdown in growth. Any of these could interact with existing fragilities. The warning is not that collapse is inevitable. The warning is that resilience is slower than it appears. This is the context in which markets must be understood going forward, not as isolated asset classes, but as a tightly coupled system where flows matter more than narratives. The $47 billion signal is one piece of that system. It points toward caution, diversification, and reduced tolerance for unchecked fiscal expansion. Ignoring it would be a mistake. The systemic fragility that this $47 billion signal highlights extends beyond debt markets. Corporate balance sheets, municipal finance, and consumer leverage all interact with sovereign debt dynamics. Rising interest costs pressure corporations with large debt loads. Municipalities faced increased borrowing costs for essential services. Homeowners and consumers feel the ripple effect in mortgage rates, auto loans, and credit availability. The magnitude of these interactions grows as leverage compounds, creating a feedback loop that amplifies small shocks into broader economic consequences. Even the seemingly stable sectors of the economy are not immune. Technology companies, which rely heavily on capital markets for financing growth and acquisitions, can experience a subtle but real increase in their cost of capital. The smallest change in interest rates or investor confidence can alter valuations, affecting employee compensation plans, expansion strategies, and M&A activity. This is why the $47 billion warning is not just a number, it is a reflection of changing financial incentives across all sectors. Institutional behavior is also instructive. When major sovereign holders adjust positions by tens of billions, the market is forced to reassess risk and return profiles across the board. Portfolio managers hedge funds hedge differently. Pension funds adjust allocations. Even insurance companies recalculate liabilities. The interconnectedness means that a shift in one corner of global capital can ripple unpredictably, affecting liquidity, volatility, and credit spreads elsewhere. One particularly overlooked element is the role of derivatives. While the $47 billion shift is a real capital movement, the implied exposure through swaps as futures and options can multiply the effective impact. A relatively modest reduction in underlying holdings can trigger changes in derivative valuations, causing margin calls or forced adjustments that pressure other market participants. These movements are often invisible until they intersect with thin liquidity conditions, creating sudden stress even in markets that appear stable. Currency dynamics further complicate the picture. As sovereign holders adjust portfolios, they may simultaneously reduce dollar-denominated assets, increasing demand for alternative currencies or commodities, while the dollar remains dominant globally. Marginal reductions in demand can affect short-term interest rates, swap spreads, and cross-currency basis spreads. This adds a layer of complexity for multinational corporations, central banks, and international lenders. The ripple effect is not hypothetical, it is already observable in subtle adjustments across foreign exchange markets, commodity hedging activity, and capital flow data. Confidence, a largely intangible variable, is central. Financial markets are, in essence, a manifestation of collective belief in the soundness of agreements, assets, and institutions. When one large actor quietly reduces exposure, others interpret that action through their own models and risk frameworks. This is why the $47 billion move resonates far beyond its nominal value. It is both a material adjustment and a psychological signal, indicating that at least one major player perceives elevated risk in the current environment. Policy response is another layer to consider. Central banks, including the Federal Reserve, are constantly balancing the need to manage inflation with the imperative to maintain financial stability. Each increase in yields affects government borrowing costs, corporate debt, and household credit. The $47 billion movement adds pressure, highlighting how sensitive fiscal and monetary systems are to shifts in demand. Policymakers must respond strategically, considering both immediate market reactions and long-term credibility. Global interconnectedness amplifies these signals. A move by a major holder in US debt affects not just the United States, but also trading partners, international investors, and global liquidity. Emerging markets may adjust their own reserve holdings. Cross-border investment flows can shift abruptly. Financial systems, which are tightly coupled through technology, regulation, and capital, become more susceptible to simultaneous shocks. The $40-7 billion adjustment is emblematic of the kind of systemic interplay that can escalate if ignored. Risk management practices are critical in this environment. Professionals look for early signals changes in allocation, bid-ask spreads, trading volumes, and market sentiment. The $47 billion movement, while subtle to the untrained eye, is exactly the type of signal that risk officers, portfolio managers, and sovereign strategists monitor closely. They understand that small, well-timed actions can prevent much larger losses later, and conversely, ignoring early signals can magnify eventual damage. For retail and institutional investors alike, the lesson is clear. Market stability is a function not only of economic fundamentals but also of confidence, liquidity, and structural resilience. The $47 billion shift underscores the importance of diversification, prudent leverage, and awareness of global macroeconomic trends. Investors who can interpret these early warnings stand a better chance of navigating the evolving landscape successfully, while those who rely solely on headlines risk being late to adjust. In addition, financial education and information transparency are paramount. Most observers do not have access to the granular data that professionals use, which explains why warnings like this are easily overlooked. By understanding the mechanisms behind capital flows, borrowing costs, and systemic interconnections, investors gain insight into the timing and magnitude of potential disruptions. Awareness, in this context, becomes a form of protection. Looking forward, the trajectory of borrowing costs, fiscal deficits, and global capital allocation will continue to interact in complex ways. The $40-7 billion warning is not a one-time signal but part of a broader narrative that even in periods of apparent calm, structural vulnerabilities exist. When those vulnerabilities intersect with policy choices, market psychology, and international dynamics, the consequences can escalate rapidly. It is important to emphasize that the $47 billion adjustment is not a cause for panic, but rather a clarion call for vigilance. It represents a moment when professional actors are recalibrating, reassessing, and hedging against risks that are not yet fully apparent. For those willing to pay attention, the signal provides both insight and an opportunity to act prudently before systemic stress manifests more visibly. In conclusion, the lessons of this episode are manifold. First, nominal figures, when viewed in isolation, can be deceptive. $47 billion may seem small compared to trillions in circulation, but its timing, context, and the identity of the actors involved transform it into a meaningful indicator. Second, systemic fragility emerges from interconnectedness. Changes in one area ripple through finance, policy, and markets in ways that are not immediately visible. Third, confidence and perception are just as important as cash flows or debt levels. Capital moves quietly when trust is tested, and the market interprets these movements instantly, even before headlines acknowledge them. For anyone looking to navigate this landscape successfully, attention to marginal shifts, global trends, and institutional behavior is essential. The $40-7 billion warning may be silent, but it speaks volumes about the evolving risks and opportunities in the financial system. Observers who understand these nuances will be better prepared to respond effectively to both opportunities and challenges. So, if you want to continue getting deep insights into moves like this, understanding global finance, debt dynamics, and market signals before they hit the mainstream, make sure to subscribe to Finance Mind. This channel breaks down complex financial events into actionable understanding, helping viewers navigate risks, spot opportunities, and grasp the forces shaping the global economy. Don't wait for headlines. Stay informed. Stay ahead.